All right. Hope everyone had a good day overall. So, pretty interesting. A lot. I think it's a really interesting day with what happened. And there's a few things. One that we can talk about really quick, the weekly chart. You can see we tested this blue line, which was October the 19th, the week of October the 19th of 2022. And on the daily chart, we've had we had a second leg trap. So leg one, which is this bar right here. Let me go ahead and label it August the 24th. There we go. So we had a rally, pullback, and then a second leg up to September the 1st. And this is always an interesting situation. You get a strong second leg up to September the 1st right here. But the problem you have is you're in the middle of a trading range on the daily chart. So strong rally, second leg, it's always dangerous to scale in. So a lot of traders, they'll be much faster to get out. So rather than buying and scaling in, they start to see two, three consecutive bear bars. A lot of those traders will just exit because they know the risk is getting too great that we can get a downside breakout. And no surprise, second leg trap, trading range day. We gapped down on the open. We tested the August 24th low and the August 2022 high, this blue line. And we came really close to the bottom of this bar right here, which was August the 29th. On the 5 minute chart, first bar of the day, we gap down and it's a big bar. A little bit of a surprise, may go at least a little bit lower. Is it always in short? You can argue it's always in short based on the gap. The market gapped down below yesterday's low, which was actually over here. We gapped below it, and the market on bar one is accepting the downside breakout. And what I mean by accepting is we are not getting a strong bull reversal bar. So that's good for the bears. Ideally, ideally to make the market always in short, more traders would rather see consecutive bear bars. And then we got follow through on bar two. Bar two, consecutive bear bars, both closing near their lows, certainly below their midpoints. Always in short, probably going to go at least a little bit lower. Far from the moving average. And if you look at the 60-minute chart, we're already, obviously we're over here. We're not all the way down, but we're getting far from the 60-minute moving average. Now, the one thing the Bears have going for them is you can see it right here. We're gapping and breaking out below a lot of bars to the left. 3, surprise bull bar, but probably sellers above 2 and probably sellers at the high of bar 1. 3 is a big enough bar that we may get at least a small second leg up. So low probably buyers on any pullback. And you can see we tested near the one high and immediately sold off. So on a smaller time frame, the market rallied on 3, pulled back into the close, and then it rallied on 4 and then sold off. So it's a two-legged pullback. What about buying below 4? I would not. It's a second entry sell after a gap down. It's forcing traders to sell in the middle of a trading range, but it's probably a better sell than a buy below. Typically, if you're buying below, it can be dangerous after a gap down. Bar 5, we have an inside bar. The bulls, they bought the close of 3. They were disappointed with 4. They bought here, disappointed on the next bar, and they tried to get out break even at the 3 close, and that's what happened on this current bar, bar 5. 6, we have an inside bar, so you can see what's happening. I've got it drawn right here. The market's forming a triangle. I'm going to go ahead and remove it because it's a little distracting. But a triangle is a contracting range, and it's breakout mode. We know the odds are high that you're going to get some kind of measured move up or down. Bar 7, big bear bar, strong enough bar. it's probably a major surprise, and we're probably going to get at least a couple of legs sideways to down. Therefore, the odds are the first reversal up will fail, and the bears will get at least another leg down. Bar 8, a reversal bar, possible second leg trap, 2 legs down, sell off to bar 2, reversal, sell off to bar 8, reversal up, but a big tail above 8. Some bulls, if they're looking for a second leg down and they're looking to buy, rather than buying above this bar right here, they'll wait for a strong reversal bar. And you can see bar 9 could not even trigger the buy above 8. You have some bears disappointed who sold to close of 7. They sold down here, disappointed on 8. They used 9 to buy back shorts. 10, bull surprise. You can call it a breakout, you can call it a surprise, but whenever you're looking at breakouts, you have to weigh the other bars in the context. For the bulls, they're hoping it's a breakout and we rally back up to here. The only problem with that is it's 2 legs up. We rallied on 8, we pulled back on 9, and then we're rallying again on bar 10. And then you can see bar 11 triggered the buy above 10 and reversed down. As far as buying or selling, you can argue it's 3 legs down, 3, 8, and 10. But 10 is a big enough surprise and a big enough bar that we'll probably get at least a small second leg down. For the bears, if they sell the close, and then 11 looks like if they sell the close of 11 and 12 looks like 10, this big bull bar, you'll have a lot of traders get out. And instead, 12 is a big bear bar. That's the close of the 60-minute hour. And you can see that's right here. So big bear bar closing on its low. The odds are the first reversal up will probably fail. And because of that, that means the upside is limited, even though it's a wedge, 1, 2, 3, and you can call it a parabolic wedge. Whenever you have a wedge or you can draw a wedge and you have open gaps, we have open gaps here and open gaps below it right here. Whenever you can draw possible open gaps, that increases the risk that this is parabolic and it'll be minor. I know you can argue that this gap closed. We have the 8 low and then 12 rallied above it. But the point I'm making is this is still possibly a negative gap. The market, it'd been better for if the bulls could have closed far above the gap. $13, we have a bull bar closing on its high. What about buying above 13? Some traders might. I think it's okay to exit shorts above 13, but the reality is you're buying after 2 consecutive big bear bars, and it's possible that bar 7 reset the count. So it's possible traders are viewing it like this. Leg 1 down to bar 8, 2-legged pullback, leg 2 down to 12, and then we need another leg down. 13, bull reversal bar, 14, low 1 short, probably buyers below 14. However, when the channel down is this tight and you're getting big bear bars, typically it's better to wait. If I'm a bull and I bought the low of 14 and then I see 15, I would get out. So the bulls, if you bought the low of this bar and you didn't make a profit, you were unable to scalp out as 15 turned up and now 15 is closing on its low, that's an automatic exit. And the bears, if you're an always in bear and you sold out of longs, or excuse me, you bought back shorts above 13, this bull bar right here, a lot of traders, they may not sell below a doji below 14. However, 15 closes on its low, they will look to sell again. In general, if I'm a bear and I'm trading always in, I'm willing to exit above a bull bar. But if it's a bear trend and the odds look like it's going to go lower, I'd want to sell below bear bars closing on their lows. 16, 3 consecutive bear bars, probably the first reversal up will fail. For the bulls, they see another wedge, 8, 12, 16. But we do not have a buy signal bar yet, so some traders, they're short and they may have a stop above 15 or 14. And then you can see what happened on this bull bar 17. 17, you can call it a failed breakout below this line right here, which I'm going to zoom over to make sure. Failed breakout. So we broke below the August 24th high. And now we have a wedge. For the bulls, trying to expand this so it's easier to see. For the bulls on 17, even though it's a doji bar and it's got a big tail below, it's a pretty decent sized reversal bar. Now, the bulls have been unable all day to make money above a bull bar. And because of that, that increases the probability that we're going to go more sideways. But it's reasonable for always in bulls, for always in bears, excuse me. It's reasonable for them to exit above 17. And you can see what happened on 18. The high of 17 is 70 and a half, and the high of bar 18 is 70 and a half. So traders, what did they do? You had so many bulls. You had bulls trying to trigger the buy above 17, but the bears overwhelmed the bulls, and traders were selling right here. 19, well, 18 is a low one short, but low one short after a possible parabolic wedge, 8, 12, 17, probably buyers below. But 18 is a big bear bar, and that will lower the probability of bulls buying below it. Typically, whenever you have a low one and it's in a second or third leg, especially when a low one within a trend, usually you get a deeper pullback and then you get trend resumption. So even though there might be more buyers below 18 and we get a couple of legs up, the reality is if you're a bull, if you're a bear and you sell the low one here, whether or not you scale in lower, you will have an opportunity to exit at your original entry. Always in bears that are still long above 19, it's probably okay to exit above 19, even though it's a small bar. Other traders, rather than buying back shorts above 19, they'll wait for a bull bar closing on its high. And that's the reason why. 20 outside down, the bulls can continue to fail to get bull bars closing on their highs and consecutive bull bars closing on their highs. Traders are unable to make money buying above bars, and that's why we continue to go lower. 21, 22, 20, excuse me, 20 outside down, 21 bear bar, and you can see we could draw another wedge. Maybe the count got reset, 12, 17, 21. And if you've noticed, I've moved the wedge all the way down. So I had a wedge here, 3, 8, 12, and then I had a new wedge, 8, 12, 17, and now I have another wedge, 12, 17, 21. And the reason for that is trends, especially tight channels, they're always forming wedges. And the wedges continue to fail. So why do the wedges continue to fail? Because you continue to get downside breakouts that reset the count. We had a big bear bar on 7, it reset the count. This is leg 1. But then you get a new breakout on 11 and 12, and that's strong enough to probably reset the count and get 2 more legs down. So you have leg 1, leg 2, and then leg 3. 21, are there more buyers or sellers? Is it better to buy or sell? The problem for the bears is it's a trend from the open, and because it's a trend from the open, we're probably going to form a trading range fairly soon. We're getting decent buying pressure and bull bars closing on their highs. Plus, the sell-off is rather climactic. For the bears, a lot of traders will trail a stop. They might put a stop maybe a point or two above every bar. And then here, same thing above 21. You'll have some traders buy back shorts 1 to 2 points above a bar, and other traders buy back shorts above 22. What about selling above 22? There's no way I'm going to sell above 22. If I'm always in bears, they exit above 22. It's a wedge with several reversal attempts. We're far from the moving average, and the odds are we're probably going to test the moving average fairly soon. 23, doji, not ideal. So for the bulls, you can see what happened. The high of 22 is 66.75. The high of this bar, 67 even. So if the bulls were all that bullish, and let me just fix something really quick. Give me 2 seconds. that should have fixed it there. Anyways, what I was saying is if the bulls were really all that bullish, buying above 22, 23 would have been a big bull bar. And instead, we sold off. And if you think about a 1 minute chart, the 21 low to the 22 high is a rally, and that means 23 is a trend line break and then a rally. In which where I'm getting at is if the next bar right here, 24, goes up and pulls back, it's a variant of a two-legged pullback on a smaller time frame. We rallied up to 22, we pulled back on 23, and then we're rallying again on 24. So if 25, 26, or 27 starts to reverse down, it would be a two-legged pullback and a 50% pullback based on this channel, the channel that began on either 12 or, either 13 or 14 down to 21. So the bears, they're hoping that this area is resistance. $25 inside bar, but a tail below 23, tail below 24 and 25, and a micro channel since 21. Probably buyers below 25 for at least a small second leg up. 26, we rallied, tested the 24 high and this pink line, which should be the August 24th high. I'm going to move it over so it's easier to see it, and it'll serve as a reminder. And then 27, we tried again. So we tried to break above it once, tried to break above it twice, tried to break above it a third time on 27, and we continue to fail. This does not look like the start of a bull trend. This looks like a minor reversal that will evolve the market into a trading range. Typically, what you have to remember is here's bar 24. So this is what the first 2 hours look like. And what that means is the first reversal up is probably going to fail. 28, reversal down, 3 pushes up, 1, 2, 3, and reversal down. The bulls, any bull that bought above 22 probably will exit below 28. And you may have some bears who who bought back shorts above 22, sell to go short below 28. The market never went always in long, therefore it's probably still always in short. The only problem with selling below 28 is you've got a number of bull bars and a micro channel since 21, and you still have yet to touch the moving average. So it's possible that we trigger the sell below 28, rally up to the moving average, and then reverse down. 29, we rallied close to the high. 29, we rallied near the 27 close. Some bulls bought this close, disappointed with 28, and the market retested it. So you had some traders buy the close 27 and then buy more at the low of 27, getting out break even. 27, some bulls bought the close because it was a bull bar closing on its high. And the reason they did that is this right here. They're hoping that they get a bull breakout of a bear flag. We have a rally, so a bear flag, and the bulls want a bull breakout and a rally up to here. And when they bought the 27 close, they're disappointed with 28. And typically, if you're willing to buy something reasonable and you're quick to manage the trade, you can usually exit break even. And that's why we rallied here. Other traders, they saw 28 as being too big of a bear bar to sell, forcing traders to sell low. So instead of selling the close of 28, they sold a 50% pullback. 30, you can argue it's a second leg down after 28. Tail below 30, so that lowers the probability for the bears, but it's a micro channel for the past 3 bars, and it's a bad buy signal bar for the bulls. Probably going to go lower and test near the 21 low. 31, bull bar, but a 4-bar micro channel, small bull body, completely overlapping the prior bar, lowers the probability of the bulls. And then 33, we have a bull bar. So for the bears, they're trying to form a wedge, down on 28, up on 28, down on 30, up on 31 and 32, and then down on 33. And then another bear bar. So we keep triggering buy signals and selling off, triggering buy signals, selling off. Tight bear channel. For the bulls, they're hoping that eventually the bears will give up and we can break out to the upside. But this is a major trend reversal attempt. We sold off, trend line break, and typically major trend reversals lead to sideways trading at best for the bulls, and typically trend resumption down. 35 reversal up, so we trigger the sell below 34, low one short and reversed up. Probably there might be probably sellers above. It's okay. I think it's okay for the bulls. Let me back up. I think it's okay for the bears to exit shorts above this bar. Probably going to go more sideways though. And you can see what happened with 36. The bears prevented this bar from triggering. So some of the bears are still short. 36, enough of a surprise. It's a bear breakout below a tight trading range. Probably going to go at least a little bit lower. And then 37 is a reversal bar. But after the bears were able to break below 21 to this bar right here, 35, they broke below it. This might be a strong enough breakout that the first reversal up will fail. 38, it's an inside bar. You can call it's a bear bar. The bulls failed to trigger the buy above 37. Therefore, you have bears who are still short. Bears sold the close. Some bears would get out above 37, the bad follow through bar for the bears, but the bulls failed to trigger it. So some bears are still short. And then we have another bear breakout on 39, and 39 is testing the August 2022 high. 40 is a doji. Follow through after 39, still probably going at least a little bit lower, but we have not touched the moving average in 40 bars. And that's a warning that this is becoming climactic, and we're probably going to touch the moving average soon. So we have a bear trend line break, and then a second leg down, and quite a bit of overlap. The bulls, they can argue it's getting parabolic, down on 32, sideways down on 36, sideways down on 39. 41, another bear bar, but getting extreme. The bears, they'll continue to trail a stop. However, the bears will get out 1 to 2 points, probably above any bar. $42 reversal up. We went down on 39, up on 40, down on 40, and then up on 41, and then down on 42 and up. So for the bulls, they can argue it's a bear break. It's a failed breakout below a bear channel. And they're hopeful that this will lead to a rally up to the moving average. And once again, the bears prevented the bar from triggering. And this is kind of a reminder. We have decent buy signal bars that are failing to trigger, and that's a sign that the bears are pretty strong. 44, reversal up. Strong enough reversal that I think a lot of bulls will buy above it, and bears will probably exit above 43. They may not exit at the high of the bar, but because of how climactic the market is, they would certainly be willing to exit 1 to 2 points above any bar. And then 40. So always in bears, exit above 44. 45, strong enough reversal up. Probably always in long, and consecutive bull bars completely undoing the past several bars. This might be the low of the day. And the context is good. We're reversing up after testing this blue line, which is 44.54 area. And that is the August 2022 high. Consecutive bull bars, probably always in long, and going to get at least a small second leg up. 46, now we have 3 consecutive bull bars. This is probably a strong enough trend line break that will get at least another second leg up. So bulls, they'll buy closes. The bears, they know the first reversal down will probably fail, but they're hoping that they can make the market go sideways long enough that we'll have to test back lower. But the only problem with that is this is strong enough For one, we've undone all the damage caused by the 36 through 43 down, the downside move from 36 to 43. And the other problem is we already went sideways for a lot of bars in here. So I think we've seen the low of the day at this point. 47 bear bar closing on its low, but this is strong enough rally, probably buyers below. Typically in a situation like this, rather than exiting below this bar, you'll have traders exiting maybe a measured move down of the bar, so somewhere down here. So if I'm a bull and if I'm going to hold at the moving average, betting that this is going to get a second leg up, I might put a stop a little bit below this measured move. In other words, I'll put a stop. I'll basically bet that the bears selling below this bar will not get a measured move of their actual risk down. 48 consecutive bear bars. However, the bulls rallied, pulled back, rallied, pulled back. So it's a two-legged pullback on a smaller time frame. Are we always in short below 48? I don't think so. I think the bears need to do more. And the bears probably need one more decent bear bar closing on its low. Therefore, you'll have bulls buying the close of 48 and buying the low of 48, betting that the bears will not get one more bar down. 49 inside bar, high one buy. High one buys and low one shorts often are better fades. This is a strong enough rally. However, if you're selling the high one, it'll probably be minor at best. What I mean by that is it'll be similar to, there might be sellers above and the market goes sideways. Let me find an example. I'm not really saying what I'm looking for, but anyways, the point is high one buys typically lead to delayed trend resumption. So what I mean by that is it's really common for bars like 49 to find sellers above the bar. So bears selling above the bar, and the market goes sideways for a bar or two and then reverses up. And you can see 50 triggered the buy above 49, and it may have triggered the buy and pulled back a little bit and then rallied. But either way, the bears that sold above 49, they got trapped on 50. And because of that, they will look to buy back shorts back at their entry price. In other words, the high of 49 will now act as resistance. And you can see those bears sold, scaled in, were able to make money. What about selling below 51? I would not. It's a doji, which means the bulls really don't have a reason to exit the trade. Swing bulls, in other words, always in bulls, they may have a stop a point or two below 51, betting that if this is going to be a bull trend, the bears should not make money below bars, similar to over here. All through here, it was reasonable for bears to exit above 22, and then maybe they get short again below 28. But look all the way down. Remember what I said? If I'm an always in bear, let's say, and I'm a swing trader, if I sell below 28 and put a stop above 28, there's really no reason for me to get out. Do I get out above this bar? Probably not. It's probably minor. You can call it a double bottom with 21, but typically double bottoms need to be closer. In other words, whenever you have a first leg down to 21 and then a second leg down to 30 and it's halfway, it's not near the prior leg, which is 21, it typically leads to a minor reversal. And that's in part why we got the downside breakout. Here, same thing. Rather than exiting above 33, with all the overlap and it being a big bar with a tail, you'll have bulls putting their stop maybe 10 ticks above the bar. Why 10 ticks? Because the market has to go 10 ticks above this bar in order for stop entry bulls to make 2 points. And even that is pretty small. This bar alone it's a 3-point bar. So maybe you could argue 2 points is reasonable. But you could see they trail their stop all the way down and eventually they get stopped out right here. So that's the same thing for the bulls. The bulls, they'll trail a stop. No reason to get out. No reason to get out below 52. 52, breaking out to the upside, we have a couple of important magnets above. We have the August 24th high, which is right here, this red line. And we also have the midpoint of the day. High of the day, low of the day. You always have to think about the midpoint. And there's a few reasons for that. One, on the daily chart, the midpoint, you can argue the midpoint. If the bulls can close above the midpoint of the day, if the bears can close below the midpoint of the day, then they have controlled the bar. And the other reason is that will damage the bull case. So you can see a measured move from the close of 44, from the open of 44 to the close of 46, takes you exactly to the midpoint of the day. And I want to say another thing about bear trends real quick. Bear trends, you'll often notice if you look at bear trends overall, you'll notice how they're much more violent and climactic than bull trends. So if you look at a 5-minute chart, it's really common for the market to sell off and be somewhat climactic and then reverse up rather violently. And it's less common for bull trends to reverse down just like this. So I'll come back here, but I want to say one thing. And part of the reason for that is you can argue it's option riders. So if you're an option rider, and let's say in other words, you're selling a put, what that means in essence is if you're buying a put, if you're a put buyer with options, you're hoping the market goes down. So if the market goes down, your option becomes in the money and your premium becomes valuable. And what that means for the option riders who sold the put, writing a put is the equivalent of writing an option is the equivalent of selling an option. The person that or institution that sold the option selling institution, if they sold a put, they are losing money rather quickly as it becomes in the money. Therefore, you'll have institutions who will short the underlying. So if pick any major institution, if they wrote puts and the market's going down rather quickly, they may begin to sell the underlying, whether that's the SPY or the Emini, to cover what they're losing. And eventually, that is in part why you can have very climactic behavior on the way down. And there's other reasons as well. But the reason why I wanted to bring that up is the reason that the market can sell off aggressively on the way down, however, and it doesn't reverse up quickly in bull trends, is most institutions are already net long various stocks. So on a weekly chart, easiest example, you have institutions that own underlying stocks. So if the market's going up, they don't have as much incentive to have to buy aggressively. And if the market's going down, they have to cover the risk. Therefore, they might start selling in order to hedge what they're losing. But anyways, I just wanted to share that real quick. So that's why sometimes you can get sharp sell-offs and then quick reversals. Another thing to think about with that is you're in a bull trend on the overall weekly and monthly charts. Therefore, traders are going to naturally look to buy pullbacks. So if we sell off a lot on a 5-minute chart, you will have traders buying and scaling in. So whenever you see a big sell-off, always look at the daily chart for support levels like the August 2022 low or the August 24th breakout point high. So no reason for the bulls to exit. You can argue a wedge, 1, 2, 3, but what do you notice about the wedge? The bears are unable to make money selling below bars, and that means you're in a small pullback trend. And we have an obvious magnet just above, measured move from the open of 44, close of 46, and the midpoint of the day, which is the same price level. Inside bar on 59, but bears unable to make money. Probably going to go at least a little bit higher. And then we got a surprise breakout on bar 60. 60, strong enough bull bar, probably get at least a second leg up. but it's a bull breakout of a bull channel. And that will lower the probability for the bulls buying up here. This is probably more of an exhaustive rally than bulls aggressively buying. The smart bulls, they were buying down here. And what are they going to do on 60, 61, and 62? You know they're probably going to take profits. Plus, you have bears who see this as an overall bear trend. And you know that those bears are going to reverse. Those bears are going to look to sell. So bear trend, it's easier to see right here. You know that this sell-off is strong enough that bears will look to scale in. 61, consecutive bull bars, but a tail on 60 and a tail on 61. And look what it did. It tested the midpoint almost exact and the measured move target. The measured move target, 44 to 47, 44 to 46 is 70.75. And this high is 70.5. So the market came within one tick of the measured move target. 62, inside bar, but a tail on 61, inside bar 62, probably sellers above, and the market's going to go more sideways. 63, bull bar, probably sellers above, and will probably test back down here. However, until the bears get a bear bar closing below its midpoint or a downside breakout, you'll have bulls who are still long and they'll just trail stops, just like the bears did down here. 65, you can see bars getting smaller, bear bar. And then finally, 66 is a surprise bear bar. Strong enough bear bar 66. We went below the past 3 or 4 bars. Probably going to go at least a little bit lower and test down here. But tight enough bull channel that the first reversal down is probably minor, which means the bear breakout on 66, 67, or 68 is probably going to be minor. And 65 is a bad sell signal bar. That also lowers the probability for the bears. 67, big bear bar, a little bit of a surprise. Probably will go at least a little bit lower, but we may not go that much lower. 68, 3 consecutive bear bars, but big bar on 67, and then a small follow-through bar on 68. If the bears were really all that bearish, 68 would be as big as 66. And even though 68 is a bear bar, it's a small bar relative to 67. And that's a warning that something's not right here. 69, sharp reversal up. Strong enough surprise, may go at least a little bit higher. But you had bulls who are buying all the way up. And they got trapped with 67 and 68. So what are those buy the close bulls going to do? If they bought and they're still long, they probably bought more down here. And they're going to be disappointed when the market gets back up here. Therefore, 69, as much of a, therefore, the point I'm making is you can buy above 69, but the upside is probably going to be limited. 70 consecutive bull bars, but you're right at resistance midpoint of the day. And if you're buying up here, it's kind of like selling down here. If you're selling the close of 68, your risk is big. So if you sell 68, your stop's up here. 1 times your risk is all the way down here, and that's unlikely. If you're buying the close of 70, your stop's down here at 69, and you know the odds are we're probably not going all the way up here. $71, small doji, probably buyers below 71, but you know the bears who sold above 68, this bear bar probably scaled in higher. So it's not all that unreasonable for the bears to sell above 68 and sell more above 65 or 66. That makes me think we're probably going to go more sideways than straight up. 72, bear bar, but after 69, 70, and 71, probably buyers below 71 scaling in lower. And that's why 73 looks the way it does. 73, high 1 buy, but right at resistance, the midpoint of the day, and the highs of 65 and 71. Probably sellers above 73 scaling in higher. 74, bull bar, but another failed breakout of the midpoint of the day. And you're so late in the day that you were probably just going to go sideways. And that's exactly what happened. For always in, I think the bears, they can sell below one, sell below two. In general, there's two thoughts I have with that. One is you're so far from the moving average that we can easily get a bear breakout and then a rally above bar one and go sideways to down. So whenever you get a gap down and a big bar one, you can easily go above bar one. So some traders, they'll sell and they'll sell more above bar one. Other traders, if they are short, they might get out a few points above the high of bar two. And other traders will just wait for a double bottom or a double top. 80% of the time, the market goes sideways for at least the market goes sideways enough to form a double bottom or a double top. Trading ranges, and what that means is the market forms a trading range 80% of the time on the open, and every trading range has some form of a double top and some form of a double bottom. Therefore, when you see consecutive bear bars on the open, bar one and bar two, it's not as high probability as what it would appear. Plus, if you look at the context of yesterday, that's a lot of bars down. And you have to wonder, there's a few things. One, quite a number of bars down. 1, 2, 3, 4, 5, 6, 7, 8 consecutive bear bars, if you include the first two bars today. And we have a trading range. The market's breaking below this trading range. We may have to retest the highs and go sideways. Bar three, I don't think it's always in long. So some traders, there's a few things. One, you may have some traders sell, and if they did, they know they're taking a low probability trade. They probably get out above three and they sell again below four, and it never triggered. So then maybe they sell below 6, 7, big bear bar closing on its low. Always in short, bears will sell. No reason to get out above this bar, never triggered. What about getting out above here? It's not really ideal because it's two legs up. Outside down, still always in short, and then follow through. I think it's reasonable to get out above 13. But if you do, you have to sell again below 15 for the reasons I mentioned earlier. It's a low one short that's getting followed through after 15. Therefore, the bulls that bought below 14, the doji, will have to exit below 15. So that makes it a decent short. And I think it's okay for bulls to buy back shorts above 17, but it doesn't trigger. And then this is not really ideal to buy back shorts above 19. It's not a great buy. It's a really small bar following a big bear bar. So there's probably sellers above. Typically, I'd wait for 2 or 3 consecutive bull bars before buying. And I'd get out of shorts above 22. Bears, they'll start selling again below bear bar like 28. And I think it's okay to get out above 33. But then what do you do below 34? I think that's pretty tough. For me, had I been short and I got out above 33, I would not sell again below 34. And if I was short and I never got out above 33, I would definitely get out above this bull bar, but it never triggered. And then we sold off. And then the next choice for the bears to exit is above 44 or a couple of points above 43. So the bulls can buy here. That makes a lot of sense. And there's really no reason for the bulls to exit. I mentioned they'll probably trail a stop one or, maybe 2 points, 3 points below every bar. And I think I would certainly look to take profits up here. If not, I'd get out below a couple of points below any bar and then certainly below 66. And then for the bulls, I don't think it's worth doing a lot in here. I think that's pretty tough. The bears, if they sold below 66, they probably get out a couple of points below 68. And the bulls, if they buy 69, this becomes rather tough. If I bought above 69 and then I see 70 and then I see 71, I would probably get out somewhere around here. And the reason is the momentum is drying up and you're at resistance, the midpoint of the day. And I think that's probably it for swing traders. For limit orders, probably sellers above 2, but I mentioned if you're selling above 2, you need to sell more above 1. Probably sellers above 8, and there might be buyers below 14, but they would take a loss on 15, and there might be buyers below 18, but if there are, I think they would get out above 19 with it being a weak buy signal bar for the bulls. Probably sellers above 19, and really sellers anywhere up here. Sellers above 23, sellers above 25, sellers on the close, and where else? Probably not really any decent limit order trades here. And whenever you get a lot of overlapping bars and micro channels that are prolonged, they do not allow limit order traders to enter. So if you're trying to sell above bars in here, you don't get filled, and that's a sign of climactic behavior. And that's a warning that this will probably not last all that long. Bad overlapping bars, bull bar here doesn't trigger, probably going to trigger fairly soon. Limit order bulls probably buying below 47, buying below 50, any of these bars right here. And then there's probably sellers above here. And then it's kind of the opposite here. Bears probably, instead of selling above 68, probably selling after a couple of legs up or hesitation. So probably selling above 66 or 67. Bulls, rather than buying the 71 low, which isn't terrible, they're probably buying closer to the 69 close or trying to buy near the 68 high. Why the 69 close? Because it's the first bull bar after 3 consecutive bear bars, and there's probably sellers above 69. And because of that, for one, even though there's probably sellers above, rather than buying the close of 69, or excuse me, rather than selling the close of 69, a lot of traders will do something called a reach trade. So they look at this bar and maybe they try and sell 2 or 3 or 4 points above the bar. So the close of this bar is 725 and the high of this bar is 71 even. So you can see what happened. The market went 15 ticks above the close of this bar. So the bulls, they bought the close at 67.25 and the market went up to 71 even. So the market needed to go up 2 ticks in order to fill those bulls. So you had a lot of limit order bears selling 4 points above 69, betting that the market would get back to the 69 close. Buy the close, sell the close. I thought it was clearly sell the close on 7, sell the close on 11, 12, and probably sell the close 15, 16. And here, I thought it was pretty difficult. Maybe sell the close 36 or 39 or 40. But if you're selling 39 or 40, you're selling pretty late in a trend. And I would get out a couple of points above any bar at that point. Buy the close 45, 46. Probably you can really buy below anything in here. And then as far as buy the close 60, 61, 62, I would not. Maybe buy the close 67, but that's really aggressive. And if I'm taking that trade, I'm going to be out really quick. So if we don't just plunge down, I'd be really quick to get out on 68 or 69 starts to turn up. And that's probably it for buy the close, sell the close. Let me take a look at questions. Well, first, where do we go from here? The Bears got their wish of a second leg trap, rally, leg 1, pull back, leg 2, closing the gaps. This is a strong enough sell off. We'll probably get at least a small second leg down. But the problem is two things. This tail right here. So take a mental image of this and let's go to the 60-minute chart. We had a pretty decent sized rally from the low of this bar to the high of this bar. That makes me think the first reversal down will probably fail and we may get a second leg up. So while I think the bears on the daily chart will get a second leg down, my concern is this rally is a strong enough rally. There's probably buyers below for a second leg up. Okay, let me look at questions. Okay, Question: is it okay to buy 60 break of the bear flag? To me, 60 is a bull breakout of a bull flag. We had a bull breakout above the moving average. We're channeling up, and 60 is a bull breakout, and you have a measured move target above. So I think it's okay to buy 60. Question: could you please compare the three strong bull closes at 44, 45, and 46, and the three strong bear bars at 66, 67, and 68, as one was a quick major reversal here, and the other was a bear reversal that ended up being minor. Yeah, so basically, let me move the chart up. So basically, what your question is, you're asking what is the difference between 44, 45, and 46 and the sell off right here? For me, there's two things. And I like to think of whenever I look at a reversal, I'm always thinking in terms of always in. And when I look at 44, 45, and 46, the bears have been, controlling the market for 40 bars. And when I look at this chart, if I'm a bear, I think you have to get out above 44. And if you didn't get out and then you see 45 and 46, the game's over. You have to get out of shorts. It doesn't matter where you got short. And because of that, if you have to exit shorts here, that means bulls are going to start buying. So this is pretty climactic, consecutive sell climaxes all the way down, and lots of bull bars. You know there's bulls buying and scaling in lower because it's a channel. And that increases the risk that we're going to reverse. Plus, you have the August 24th breakout point high right here, which is this magenta line. Let me just make it the same, just so it's not as confusing. And you also have the August 2022 high. So you're at resistance on higher time frames. And for me, when I'm if I'm so that covers this. I thought we would get at least a second leg. That's a strong enough reversal for a second leg. Here, what about this? Why isn't this a strong enough reversal? Well, 68 is a bear bar and it's below the moving average, but it's the first bear bar completely below the moving average in the past 20 bars. So it's a minor reversal here. The bears have been below the moving average for a lot of bars, and the bulls were able to get a very strong reversal up. And look at the bodies. 45, big bull bar. 46 is pretty much the same size as 45. That increases the odds of higher prices. Big bear bar on 67, and then another big bear bar on, and then a smaller bar on 68. That lowers the probability. Okay, question. Al says that most swing trades, or always in long, always in short, do not lead to swing profits and often result in small wins or small losses. Any idea what your win loss ratio should be? That's a generalized question, and you can take it two ways. One is, let's go to a different day. Let's go here. This is a good example. And what you'll notice is on a typical trading range day, which this was a pretty strong trending open, on a typical trading range day, consecutive bear bars, it's always in short. And if you sell, a lot of traders, they know that the odds are the market's going to be in a trading range. And if they're selling, they're hoping for a bear trend, but they know it's probably not, they know it's probably not going to be a bear trend. And because of that, what they will do is once the market starts to go sideways, they get out. But what he means is if you're short and then you get a bull bar, you exit. If you buy this bar, 10, hoping for a strong reversal up, 11 is a good bar, but then you see 12, reversal down. A lot of traders get out. If you buy here, you got a couple of legs up. If you sell below 23 or 24, you go sideways for 5 or 6 bars, but then you get out above 30. And if you were in the trading room yesterday, I talked about that. I talked about leg counting and how traders will often exit after 3 legs up or 3 legs down. But as far as win to loss ratio, I would say most traders should try and swing trade and go for twice the risk. And with always in, you think about it kind of like what I mentioned today. Sometimes you get lucky. You sell below 8, you sell below 7, strong enough bar for a second leg. You get out above 13, but then you sell again below 15. And then there's really no reason to get out. If you get out above 22, which I think it's reasonable, it's a minor reversal. And therefore, if you buy back shorts above 22, you've got to sell again below 28. Another way to think about that is whenever the market sells off and you start to get a decent small pullback bear trend, a lot of traders will wait for a trend line break of the moving average and then a retest. So some traders, they'll stay short above 22 and they'll ignore all of this. And then eventually they see that the market went sideways for a lot of bars, and then maybe they see 44 and 45. They start selling out of longs at that point. Buying back shorts at this point. Okay, I've got time for one more question. I sold bar 10, but I was afraid of a third leg. How do I know it's not a third leg? So sold bar 10 here. And how do they know it's not a third leg? Well, I'm not sure if you mean you sold the close of 10 or below 11, but either way, that is the hard part. That's why a lot of traders, if they're quick to get in, a lot of traders that are a lot of traders over time become scalpers because they feel they're able to get in and get out. But anybody, it doesn't matter if you sold below 6 or below 1 and you stayed short. If you're short down here, regardless of if you sold the 10 close or below 11, if you're short, you can take a chance and get out above 13 and then sell again below a bear bar. 13 is probably a minor reversal. And with 15 closing on its low, a lot of traders will sell again. And the reason is 7 was a big enough surprise. It may get 2 or 3 legs down. So leg 1 down to 8, leg 2 on 13, and then leg 3 down here. And then the market never really allowed the bulls to get a decent buy signal bar that triggered. All right, so that's all the time I have for today. Tomorrow will be interesting. I suspect after the size of this bar and the rally into the close, tomorrow might be an inside day. So I think that the bears are going to be disappointed. And if we sell off tomorrow, we'll probably find buyers and we may form a higher low with yesterday, which means that tomorrow, the low of today, which means that we may form. Let me back up because I'm sure I'm sounding confusing. What I'm saying is we may sell off tomorrow, but we may form a higher low relative to today's low. But we'll see. All right. Hope everyone has a good rest of their day, and I will talk to everybody soon. Someone asked, how do they join the room? And you join it. You can go to the Brooks Trading Course website, or you can go to, let me figure out how to, or you can go right here. Let me see if I can get this to work. There we go. You can click on this website right here, brookspriceaction.com, and you can sign up right there. So I'll leave that on for a couple of seconds. All right. And tomorrow's Thursday, so there will be another YouTube end of day review, and I will talk to everybody then. All right. Hope everyone has a good rest of their day.